Hello, everyone, and welcome back to Golden Seniors Hub, your trusted source for information to help you navigate retirement with confidence. If you are a homeowner aged 62 or older, or if you are planning for your financial future in retirement, there is an important update you should know about. We have received many questions about changing regulations regarding financial transparency and how they might affect senior homeowners. There are currently many discussions online about updates taking effect on May 1st, 2026, regarding the reporting of financial transactions to the IRS. Today, we are going to clear up the confusion. We are not here to alarm you. We are here to equip you with facts. In this comprehensive guide, we will break down what these reporting changes actually mean, which transactions might be involved, why these updates are occurring, and, most importantly, the proactive steps you can take to ensure your financial house is in order. Our goal is to help you understand the landscape so you can make informed decisions about your home, your equity, and your retirement security. Let's get into the details. To understand the current environment, we first need to look at how things have traditionally operated. For decades, home equity has been a cornerstone of retirement planning for millions of Americans. It's often your largest financial asset, your nest egg. Historically, financial moves like taking out a home equity loan, a line of credit, or even a reverse mortgage were largely private financial arrangements. While transactions were documented legally, specific automatic details about the funds you received were not always reported directly and instantly to tax authorities by financial institutions. This meant the responsibility for tracking and accurately reporting any relevant tax implications rested primarily on you and your tax preparer. Starting recently and moving forward from May 1st, 2026, the threshold for that reporting is shifting toward greater transparency. Government agencies, including the IRS, are emphasizing enhanced reporting requirements for financial institutions. When we talk about mandatory lender reporting, it means that the banks, mortgage companies, and financial entities you work with are now required to file certain information disclosures with the IRS more frequently and with greater detail than in the past. This isn't just for seniors, it's part of a broader government push for improved tax compliance and data accuracy across many demographics. What does this look like in practice? It means that when you engage in a significant financial transaction involving your home, the IRS is more likely to receive a record of that transaction shortly after it occurs. It is crucial to understand this distinction. This change is about reporting data, not necessarily about increasing your taxes. The IRS is getting a clearer, more immediate picture of the flow of funds. The goal is to ensure that what you report on your annual tax return matches the data that institutions report to them. Naturally, the first question many people have is, which of my transactions are being tracked? While final regulations continue to evolve, the enhanced reporting rules primarily focus on activities that involve substantial funds changing hands or a change in property ownership. Here are the three main categories to understand. First, reverse mortgage disbursements. Reverse mortgages, particularly the federally insured home equity conversion mortgage, or HECM, are popular tools that allow seniors to tap into their equity without selling their home. Under the older system, you received your payments, whether as a lump sum, a line of credit, or monthly tenure payments, and the lender kept its own records. Under the updated requirements, lenders must now file more specific disclosures detailing the amounts disbursed to you during a calendar year. If you took a $50,000 lump sum or received $1,200 every month, that specific cumulative figure is now reported to the IRS. Second, home equity loans and HELOCs. Similar rules apply to traditional home equity products. If you are a senior homeowner and you take out a new loan or draw a significant amount from a HELOC, the lender is now required to report that transaction event to the IRS. There are often threshold amounts involved. Smaller loans may not trigger the reporting, but substantial ones certainly will. Third, real estate property sales. When a home is sold, a substantial financial event occurs. The IRS has long required closing agents to report basic sale information. However, the updated reporting environment means this information is transmitted more seamlessly and is cross-referenced more effectively. If a senior sells their primary residence or a second property, the total sale price is reported directly. This allows the IRS to quickly identify situations where a tax obligation might arise. We must emphasize that this reporting does not necessarily make these transactions taxable. Many common scenarios, like reverse mortgages or standard primary residence sales, often have no associated income tax. The change is simply that the IRS now knows about them sooner and will be expecting them to be addressed on your tax filing. Understanding the motivation behind these changes helps you understand the scope of the government's efforts. The primary drivers are data accuracy, tax compliance, and modernizing the tax system. For several years, the Department of the Treasury and the IRS have been analyzing gaps between the taxes theoretically owed and the taxes actually collected. They utilize advanced data analytics to identify sectors and transaction types where underreporting may be common. Their analysis indicated that large-scale transactions, such as property sales and equity draws, represented significant areas of potential non-compliance or simple error. In many cases, taxpayers genuinely did not know that a certain transaction had complex tax implications. They didn't mean to misreport. They just didn't have the right guidance. Other situations involved more complex scenarios that simply slipped through the cracks. The solution decided upon by policymakers was to shift the burden of reporting information away from the individual taxpayer and onto the large financial institutions that facilitate these transactions. These banks and lenders have the sophisticated systems needed to automate and submit this data accurately. By requiring this direct reporting, the IRS improves accuracy by receiving a verifiable number from a third party, reducing simple math or reporting errors by the taxpayer. The automated systems can easily cross-reference the data reported by the lender against the data you provide on your tax return. This allows for early intervention. If there is a discrepancy, the IRS's systems are designed to identify it early, allowing you to resolve potential issues without facing years of penalties and interest later on. It's about bringing more efficiency and transparency to the system, making sure everyone is operating with the same information. Furthermore, these changes are part of a larger digital transformation within the federal government. By moving toward real-time or near real-time data reporting, the IRS aims to reduce the massive backlog of manual paper audits and focus instead on high-level automated verification. This means that as a homeowner, you must move toward a similar level of digital or organized record keeping. The days of simply hoping the numbers align at the end of the year are fading. The government is looking for precision, and they are using technology to achieve it. This modernization also helps protect against identity theft and fraudulent property transfers, as the IRS can now verify the legitimacy of large transactions against known taxpayer profiles more effectively. The most confusing and potentially surprising area involves not direct taxation, but the secondary effects on related government programs like Social Security and Medicare. This is where most complexity lies and why accurate financial reporting is so critical for seniors. Many seniors do not realize that their Social Security benefits themselves can be subject to federal income tax. Whether you pay tax on your benefits depends entirely on your combined income. Combined income is the sum of your adjusted gross income, any non-taxable interest, and 1/2 of your Social Security benefits. If this combined income total exceeds specific thresholds, you may have to pay tax on up to 50% or even up to 85% of your benefits. These thresholds are remarkably low and have not been adjusted for inflation in decades. For individuals between $25,000 and $34,000 in combined income, you may pay tax on 50% of benefits. Above $34,000, it can be up to 85%. For married couples filing jointly, those thresholds are $32,000 and $44,000, respectively. Why does this matter with the new reporting rules? Imagine you sell a property. Even if most of the profit is excluded from your income tax, the reported sale price might still push your adjusted gross income up for that year. The IRS sees this transaction, automatically calculates your potential combined income, and flags that your Social Security benefits might be subject to higher taxation. If you don't account for this and pay the correct estimated taxes, you could face an unexpected bill. Accurate reporting, which the new system ensures, is key to managing this situation correctly. Medicare premiums are another area where seniors can be blindsided. While most people pay a standard premium for Medicare Part B and Part D, the government requires higher income beneficiaries to pay an extra surcharge called IRME AA. This amount is not based on your current income. It is based on your modified adjusted gross income from 2 years prior. For 2026 premiums, they look at your 2024 tax return. This creates a serious challenge when you have a one-time financial event. Let's say in 2024, you sold a long-held investment property, resulting in a large capital gain. That transaction is now reported automatically to the IRS and cross-referenced with your Social Security and Medicare records. In 2026, you may suddenly receive a notice informing you that your Medicare premiums are dramatically increasing, perhaps by hundreds of dollars per month, because of that 2024 transaction. The enhanced reporting makes it much more likely that the standard IRMA process will correctly identify your past higher income year, leaving you with little recourse but to pay the adjustment. This underscores the need to be aware of how large-scale transactions today can impact your expenses multiple years into the future. It also highlights why working with a professional is so vital. They can help you perform a 2-year projection to see if a sale today will trigger an IRMA surcharge down the road. To provide clarity and reassurance, let's address 2 specific areas where many misconceptions exist: home sales and reverse mortgages. This is where authentic, accurate information is vital. We mentioned earlier that home sales are reportable. This does not mean they are automatically taxable. In fact, most senior homeowners in the United States benefit significantly from the primary residence exclusion. If you sell your primary residence and have owned and lived in it for at least 2 of the 5 years leading up to the sale, you can typically exclude up to $250,000 of profit if you are filing individually, or $500,000 if you are married filing jointly. Here is the key. The direct reporting by the closing agent to the IRS simply records the total sale price. It does not tell the IRS your original purchase price, what improvements you made, or if this was your primary residence. The risk isn't that you lose the exclusion. The risk is that the IRS will expect you to properly address this transaction on your tax filing and substantiate your exclusion calculation. If you have a $600,000 sale and are married, and you don't report it correctly showing your cost basis and exclusion, the IRS's automated system may flag a large potential gain. Accurate documentation and reporting are essential here to prove you are entitled to the exclusion. This is specifically where many homeowners fail. They assume the exclusion is automatic and leave it off their return entirely. Under the new reporting guidelines, leaving a reported sale off your tax return is a near certain way to trigger an automated notice from the IRS. Even if no tax is eventually owed, responding to these notices can be stressful and time-consuming. Let's address a very common point of confusion. Is my reverse mortgage taxable? The simple, definitive answer in almost every case is no. The money you receive from a reverse mortgage is classified by the IRS as a loan, not as income. Think of it like this. If you take a loan from a bank to buy a car, that money isn't considered income, and you don't pay taxes on it. You are simply receiving funds you are obligated to repay later. However, the new reporting rules still require the disbursements to be reported. Why? Because the IRS is building a complete financial picture. Even though the money isn't taxable, receiving substantial loan disbursements can still be cross-referenced to ensure other aspects of your financial filing are consistent. For example, the IRS might cross-verify your other reported sources of income or look at deductions you have claimed. The crucial takeaway is that the transaction being reported does not create the tax. It simply means the information is on record, ensuring your complete financial filing is accurate. We have spent a lot of time discussing the potential for confusion and error under the new reporting rules. But this isn't cause for alarm, it's a call to action. The goal is transparency, and you can thrive in this environment by being proactive and organized. If you take the following 3 steps right now, you can confidently navigate this updated landscape. Step 1. Partner with a specialized tax professional. The single most impactful action you can take is to find and meet with a tax advisor who truly understands the unique financial complexity faced by seniors. Your traditional tax preparer is certainly capable, but the financial landscape for seniors involves complex layers like Social Security, taxation thresholds, and Medicare's look-back periods that require a high degree of specialized expertise. Look for a CPA or an enrolled agent who has a strong focus on elder financial issues or retirement planning. When you meet with them, bring your property deed, documentation of all significant home improvements over the years, recent reverse mortgage or HELOC statements, Social Security annual benefit statements, Medicare premium notices, and your last 2 to 3 years of tax returns. This proactive meeting can help your advisor identify potential vulnerabilities and suggest legal, effective strategies to structure your finances. Step 2. Get your home improvement documentation in order. If you have owned your home for decades, the original purchase price is likely very low. If you sell for a high price, your potential gain could be substantial. The primary residence exclusion is your best defense, but if your gain exceeds the exclusion limits, you will need to prove any capital improvements you've made over the years. Improvements like a new roof, upgraded electrical, or remodeled kitchen add to your cost basis, which directly reduces your taxable profit. Start gathering this documentation now by searching old paper files, checking digital records in your email, or looking for bank statements showing payments to contractors. Even partial documentation is far better than none. In fact, taking photos of major renovations today can serve as supporting evidence alongside your receipts. Many seniors find that a simple digital folder on their computer or a physical accordion file dedicated to home capital improvements can save them tens of thousands of dollars in potential tax liability down the road. Step 3. Carefully review your reverse mortgage or HELOC situation. If you have a reverse mortgage or a large HELOC, or if you are considering one, now is the time to be thorough. If you have one, contact your lender and request a complete transaction history for the lifetime of the loan. This should show every single disbursement, line of credit draw, fee, and interest charge. If you are considering one, consult with that senior specialized tax professional before you sign any documents. They can help you understand the long-term impact on your combined income, MHI, Social Security taxation, and IRMA. Proper structuring of how and when you receive your funds can dramatically affect these outcomes. For instance, taking a line of credit as needed rather than a single large lump sum might help you stay below certain income thresholds for Social Security and Medicare purposes. The landscape of financial reporting for senior homeowners is becoming more transparent. The rules regarding direct information reporting by lenders starting May 1, 2026, are part of a broader government effort to enhance data accuracy and tax compliance. Transactions like reverse mortgages, home equity loans, and property sales will now generate automatic disclosures. But this isn't something to fear. This updated environment simply means you must be more diligent and organized. Proactivity is your greatest asset. By organizing your home improvement records, consulting with a knowledgeable tax professional, and understanding how your actions today can impact your finances tomorrow, you can ensure your financial house is secure. The goal is accuracy and confidence, not alarm. You have a proactive window right now to review your situation, organize your records, and meet with a trusted expert. As always, thank you for joining us at Golden Seniors Hub. We are dedicated to providing you with the reliable, authentic information you need to thrive in retirement. If you found this guide helpful, please give it a thumbs up and subscribe to our channel for more valuable content. Let's work together to make your golden years truly golden.